South Africa's jobless rate has edged up. It increased to 32.9% in the first quarter, as the number of unemployed persons rose by 330,000. The sectors that recorded the highest losses include community and social services, followed by the construction industry. According to Stats SA, the youth remain vulnerable in the labour market. This segment saw its jobless rate increase to 45.5%. Mining production for March has come in worse than expected. After the previous month's gain of over 10%, output declined by nearly 6%. The market had pegged in a drop of 2.2%. The contraction was broad-based. Investec's Lara Hodes says that the mining sector continues to face a number of key challenges. She's added that the deterioration of the country's water infrastructure and the poor state of the roads and railways continue to impede optimal activity and export potential. Anglo American has announced a radical restructure. The miner has proposed that Anglo American Platinum be demerged. It suggested a demerging or divestment of De Beers, and the company intends to sell its steel-making coal assets and either close or sell its nickel operations. Anglo believes this will leave it with a simpler structure consisting of copper and iron ore assets, as well as its crop nutrient project, Woodsmith, which it will delay in an effort to improve its balance sheet. Once completed, the group will have less than 1.5 times net debt to EBITDA at the bottom of the cycle. It will be able to maintain its 40% dividend payout policy and reduce costs by $1.7 billion. The announcement comes as Anglo tries to rebuff takeover proposals from BHP, the latest of which came through yesterday. On that note, BHP is likely to sweeten its $43 billion takeover offer for Anglo American. That's according to investors. Shareholders in both companies believe that a second improved offer could add cash to the mix. Anglo rejected BHP's advances for a second time yesterday, saying that the approach continues to significantly undervalue the company. BHP has until May the 22nd to make another offer or walk away. Equites Property Fund has reported a distribution per share of 131.1 cents for the year through February. This put it in line with guidance. A final dividend of 65.7 cents per share has been declared. This takes the total for the year to 131 cents, which is 22.7% lower than the previous period's payout. Moving forward, the board expects the distribution per share to remain relatively in line with what was achieved this year, and so be within a target range of 130 and 135 cents. Octodec has reported a 6.4% decline in half-year distributable earnings per share. The property firm attributes the fall to its operations being adversely affected by the high interest rate environment, low economic growth and lack of service delivery from municipalities. Looking ahead, the group expects interest rates to remain higher for longer and says this will have a negative impact on the business. As a result, the board won't at this stage provide any guidance on distributable income and dividends for the second half. Tipula has posted a near 5% dip in half-year distributable earnings per share. The firm believes that market conditions for the rest of this financial year will be stable. Given this, the board anticipates that distributable earnings per share for the second half will be in line with the current period. MTN has revised down its expected capex deployment for 2024. It has forecast capital expenditure of between 28 and 33 billion rand. That's due to a reduction in anticipated spend by MTN Nigeria. The announcement comes alongside the release of a first quarter update. During the period, service revenue fell close to 19%, voice revenue decreased 32%, and data revenue fell 14.7%. One silver lining was fintech revenue, which rose 11.4%. Canal Plus has increased its holding in MultiChoice. The French media group now owns a 45.2% stake in Africa's biggest pay TV operator. That's as the firm forges ahead in its bid to take control of the DStv operator. Investors are waiting on a combined circular which will outline the details of Canal Plus's bid to buy MultiChoice. That circular is due to be released on the 4th of June. Further afield, Sony Group says it sees operating profit growing 5% to $8.2 billion this business year, with a boost coming from its image sensors. Let's take a look at this package report for more.
Sony sees profits growing this year. The Japanese tech giant forecasts 5% growth to $8.2 billion thanks to a boost from image sensors. Sony is a major supplier of the technology for smartphones. That is seen helping its chips business to book a 40% rise in operating profit on higher sales and lower costs. On Tuesday, Sony announced a 7% fall in operating profit for the year ended March, in line with estimates. It saw lower profits in its insurance business and was hit by a slowdown in the gaming sector. The firm sold 20.8 million PlayStation 5 consoles last year, just missing its target of 21 million. Sony blamed weaker than expected sales over the year-end shopping season. But it sees better times ahead and projects profits that its gaming business will rise 7% in the current year. It cited factors including higher sales from its PlayStation Plus subscription service. The gaming industry slowdown saw Xbox maker Microsoft move to close studios in cost-cutting measures. Sony also said in February it would lay off 900 workers at its gaming business and shut a London studio.
And Apple supplier Foxconn reported a 72% rise in first quarter profit, boosted by strong demand for AI servers and coming off a low base from the same period a year earlier. Here's more detail in this package report.
Profits have surged at iPhone maker Foxconn. They jumped 72% over the first quarter. That still fell short of forecasts, but marked the third straight quarter of rising profits. It's not consumer electronics driving gains for the world's largest maker of gadgets for big brands, however. The firm expects demand for such products to be flat this year. Instead, the Taiwan giant is another tech firm excited about AI. It says products like ChatGPT are driving a surge in demand for servers. Foxconn is predicting a big rise in revenue this year, partly as a result. That could also lift the value of its big stake in Sharp. Last year, Foxconn had to take a write-down over the Japanese firm's troubles. Now it says the worst is behind Sharp, with one of its factories to be turned into an AI data center. Foxconn shares have risen around 65% this year on hopes that it is set to benefit from the AI boom.